in this increasingly volatile world, there are more and more calls for better benchmarks, particularly physically deliverable benchmarks that allow for better price discovery.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is presented by Base Carbon, sensible carbon investing. For more information, visit basecarbon.com.
Welcome back to Carbon Frontiers 2025 on Smarter Markets. I'm Dave Greely, Chief Economist at Abaxx Technologies. Our guest today is Alasdair Were, Head of Environmental Markets at Abaxx Exchange. We'll be discussing how recent dramatic policy changes and hard economic realities are influencing both corporates and governments' approach to the energy transition, what it means for the carbon and environmental markets, and some of the potential paths forward. Hello, Alasdair. Welcome back to Smarter Markets.
Thanks, Dave. It's great to be here again.
Well, it's great to have you here, and I really appreciate you making the time to talk with us today. I know it's been a very busy week for you as you just returned from the eWorld Energy and Water Conference in Essen, Germany, which for our listeners who may not know is a leading gathering of the European energy industry. But before we dive into the carbon and environmental markets, I wanted to ask you if you could share with us some of what the big topics of conversation were at eWorld this year, and what was the mood?
So I think it was a fascinating event, and I think it's very interesting to compare this year versus last year. Obviously, Essen sits at the center of the German industrial heartland, surrounded by a lot of the big utilities. And so it was interesting to get their take on the state of the economy, where Germany is going, some of the challenges they're facing. I think particularly in light of Trump and some of the narrative that the current administration is putting out, it's, I think, led to big industry in Germany kind of reconsidering the direction of travel they're going in. I think we're all aware the challenges German automotive sector has faced over the last couple of years. And it's interesting to see, again, today, an announcement or a prediction that GDP will be down another 0.5% this year, third year in a row, and whether there's room for reconsideration of some of the environmental policies. Obviously, in the US, we've seen a swing from left to right. We're running up into elections in Germany. I think we're seeing similar pendulum swings from left to right. And high up on the agenda, obviously, is some of the environmental and climate-focused policies that the Green Party pushed through over the last couple of years. And so I think largely at the front of a lot of the conversations that have been had at eWorld over the last few days is, what's the direction of travel of Germany? To a larger extent, what's the direction of travel in Europe over the next couple of years? And it'll be interesting to see how those conversations play out, obviously recognizing that things tend to move incredibly slowly at the Commission. But I think it's starting to swing towards a more commercially driven approach versus a more ideological, environmentally driven approach. And so I think for me, that was a big takeaway. I'm looking forward to diving into that in a little bit more detail in this conversation.
Yeah, so many great threads to dive into, and it ties into a lot that we've been hearing on the podcast this year. You know, you talk about German auto industry, and remember Andy Home talking about how EV sales in Germany were actually down year on year with the removal of certain subsidies. And then just last week, we had Mark Lewis on the podcast, and he was discussing how with the EU ETS now at roughly the halfway point of its life to get to an absolute zero target, that the baton for emissions reductions was being passed from the power sector to the industrial users. And at the same time, energy is expensive in Europe. We've had the cutoff of Russian supplies, Europe very reliant on US LNG. And now, of course, you've got President Trump pulling the US out of the Paris Agreement once more. So the competitive landscape for European industrials is getting tougher. As you said, Germany's at the heart of the EU energy industry. Did you have a sense of how they're starting to think about what all this means for European industry?
I think there's a realization that Europe needs to become more competitive. Only today we saw that the build out of coal power plants in China is at a 10-year high. Obviously, the US is really promoting a growth first economy. And I think it's going to be incredibly difficult for Europe to compete against these two factions if they continue down the path. I think there's a recognition that moving away from the environmentally driven approach towards a more pragmatic approach when it comes to power is probably inevitable. I think it'll be fascinating to see how conversations go at the US-driven negotiations on peace or potential peace in Ukraine and what that means for energy flows. I think it was surprising to hear the number of people talking about the reparation of Nord Stream and potentially Germany going back to being somewhat suddenly less dependent upon Russian gas, but moving to a world where that's something under consideration. Because in the absence of cheap energy, I think the industrial heartland of Europe is going to continue to struggle. And so that's, for me, I think the big kind of takeaway remains kind of somewhat interesting. What happens going forwards? Again, if we look at Japan's also making a shift back to nuclear. Does Europe turn back on nuclear again? I think that's probably a likely outcome as well. At the end of the day, Europe really needs to find that competitiveness again. And I guess as an anecdote to that, we've seen Europe reassess the implications of CBAM, and I'm sure we'll dive into that in a little bit more detail. But there's a realization that the historical approach that Europe's taken is perhaps not necessarily viable going forward.
And it's really striking to hear the reconsideration of becoming more reliant on Russian natural gas. I think it clearly shows that no idea really seems to be off the table at this point in dealing with trying to make Germany and Europe more competitive. I was also curious, at eWorld, there's a lot of different alternative energy providers, for lack of a better word. I think a lot of new sources of energy were being pushed in recent years as being more sustainable. And I'm curious, was there a change in the conversation over sustainability and some of the newer sources of energy supply at the conference?
What was quite interesting is a lot of the narrative around climate neutrality, carbon neutral fuels was really gone or less visible this year. And even I would say that the presence from entities involved in the voluntary carbon market was less visible this year. There was a lot more focus on things like biomethane and some of these more climate-friendly fuels. Another big one that I think was interesting to watch was kind of the downgrade in ambition of hydrogen. Obviously, Germany's been at the forefront at pushing the hydrogen agenda. And I think there's a realization that the energy transition is going to take a lot longer than previously envisioned. If you look at some of the climate commitments that firms have made over the last few years around 2030, 2050 goals, for the most part, they're well behind achieving those. And whether that's down to consumers not necessarily desiring the products, as we've seen with EVs, or the fact that technology has not developed at the pace expected, we're seeing a lot more pragmatism when it comes to the kind of energy mix. That's not to say that renewables aren't visible and aren't at the forefront. Germany's done a phenomenal job at transitioning their grid to be increasingly reliant on renewables, whether that's wind, solar, hydro, etc. But I think there's also a realization that traditional fossil fuels are not going to be replaced at the rate that was originally expected. And so it's about trying to create these intelligent solutions that achieve the climate goals that we may have as a population, not at the expense of economic growth.
And I'm curious, has that pragmatism, do you see that extending over into the policy realm and the policy agenda in Europe, including the ETS and implementation of CBAM?
So yeah, as mentioned, I think we had news earlier this week that they're going to reduce the participation in CBAM by about 80%. So the vast majority of small firms that were, in theory, going to be covered under CBAM no longer have to report. So it's really a focus and prioritization on the larger firms that have the ability to quantify their footprint. I think the other shift that's of interest is a focus on the carbon intensity of the goods moving in versus the economic value. So I think we're being a little bit more pragmatic, or I think the policymakers are being a little bit more pragmatic. That being said, there's a lot that still needs to be resolved over the coming years. And I think 25 and 26 are going to be crucial for the future implementation and success of EU ETS, particularly ETS2. I think what will also be interesting is the role of tariffs and how tariffs impact some of these environmental policies. I think obviously we're going to see some fairly aggressive tariffs being pushed out by the US, even if they're just ideas versus actually implemented. It'll be interesting to see how Europe reacts to some of these tariffs. One of the, I guess, potentially more positive outcomes of these tariffs is kind of an onshoring of supply chains. And it could lead to reduced environmental footprints for products that consumers buy. As supply chains become less global in nature, we see a lot of kind of nearshoring of production. There could be some interesting unintended environmental benefits to some of these policies that the current administration is pushing out.
It's fascinating to think that you could get emissions reductions through shrinking supply chains driven by tariffs and a lot of the increasing hard line on trade that a number of countries may be taking. It was interesting. I was listening to someone the other day who said that the vast majority of global trade now occurs within companies and kind of within the subsidiaries of the different companies. A good often goes back and forth between countries. I think this was in the case of like US and Mexico and Canada, like 25 times before it's actually a finished good. So when you have to start accounting for that, you can see it really has an impact. Maybe we could broaden out the conversation a little bit, from Europe to the wider landscape facing the voluntary carbon markets. And how do you see that relationship between the compliance markets and the voluntary markets evolving, given the pressure on compliance markets like the EU ETS and a lot of the difficulties that the voluntary markets have had to deal with over the past couple of years?
So, obviously, Mark did a wonderful job in last week's episode of explaining the potential linkages between an Article 6 market and the EU ETS in light of a reducing allowance cap. On a global basis, I think we're seeing a lot more focus on regional compliance markets and utilization of voluntary credits towards achieving that compliance, whether that's in Japan with the JCM or Singapore with the Singapore carbon tax. I think that's where we're seeing demand for the most part, given an absence of voluntary demand currently. And I think it's going to be interesting to see how, again, the Trump administration's kind of anti-climate push impacts the decision-making of some of these large American corporates. Obviously, we saw last week the Bezos Earth Fund pulling out of funding of SBTI. I know the FT framed that as being an intention to align more closely with Trump administration's thinking. It'll be interesting to see whether more large American firms follow that direction and pull back from some of these voluntary participations. But what we've seen even today is an announcement from a bipartisan group, including Microsoft and Exxon, creating a task force focused on the voluntary carbon market. So I think it could be that we see corporates really stepping up into the abyss as the US pulls out of supporting climate initiatives. It's going to be interesting to see how the voluntary market evolves and how that intersects with compliance markets.
it's easy to understand the motivations of corporates who might want to pull back at this point. But when you mention corporates that might step forward, what is motivating them that you're able to see?
So I think for the most part, it's really just a social license to operate. If you look at the hyperscalers, obviously their emissions footprint is going through the roof currently with the rise of computing linked to AI. And I think there's a recognition that that footprint is only going to continue to grow as the level of compute grows. So in the absence of government supervision and regulation, it is probably the right thing to do. And I think there was a very nice anecdote that someone gave at eWorld a few days ago. As morally conscious individual, if you drop trash on the floor, you pick it up. And I think a lot of corporates are thinking about their emissions footprint much in the same way. As a morally conscious corporate, if you understand and can calculate your footprint, if you've got the financial ability to do so, you should probably do something to counteract that. And the profit margins of the hyperscalers remain very healthy for the time being. And I think they're some of the few that are in a position to really do something very meaningful about it. So they're, I guess, going to lead the path forwards over the next few years.
It's interesting. And if you kind of look at the other side of it, on the supply side, the project development side, how serious has the overall impact on and need for carbon finance been affected by these recent policy changes in governments and corporate boardrooms? How big an impact, how big a dearth of carbon financing do you think we're seeing for project developers these days?
So I would say that there's still a real challenge out there for project developers to attract the kind of finance they need. In certain segments of the market, and I'd largely say that's removals focused, there is demand, but probably not enough to create that sort of ramp up to a gigaton size market. I think the avoidance space is probably struggling a little bit more. We've seen the US government pull back their funding or pull out of their funding for the LEAF Coalition, who has been probably at the forefront of the development of a jurisdictional red market. And on the secondary market side of things, I think the market remains very quiet. So you've got a somewhat active primary market. The secondary market is struggling, although I think there's an expectation that it will begin to tick up. But a number of the more speculative entities, whether that's trade houses, hedge funds, etc., that had made a bet on the future of the VCM are perhaps dealing with write-downs and right-sizing of their businesses.
Absolutely. In addition to like potentially the trend of the path forward changing, how much is just the kind of radical uncertainty that's kind of permeating due to not knowing the direction of policy, not knowing the direction of where and when and at what level tariffs will be? How much is that, you think, causing people just to freeze or, maybe more politely just step back and wait and try to figure out how things are moving and in what direction before they take any strong action or investment?
That's absolutely a challenge the market faces. And I think we see that in the CORSIA market currently. Obviously, airlines are aware of the obligations that they have to be held to. The challenge, I think, is currently there remains only one project that's eligible for delivery into CORSIA. And so airlines are sitting on the sideline trying to understand, okay, what is the supply side going to look like? How many more standards are going to be eligible? How long is it going to take for more projects to come to market? And part of that is challenges around host countries issuing LOAs. Part of that is project developers struggling to find the financing that's required to develop the projects that CORSIA will need. And a portion of it is really kind of capacity building at the country level. It still remains, I think, a challenge for a lot of countries to understand what's required of them to comply with the needs of the market and what it takes to issue those letters of authorization to become CORSIA eligible.
Yeah, and of course, CORSIA Corsia Phase 1 contract is one of the futures contracts you have listed at Abaxx Exchange, where you're the head of environmental markets. The other current carbon offset futures contract is for JRED Plus methodologies. Curious, how are you thinking about your current futures contracts in this environment?
So I think when we launched those products, we were cognizant of the fact that they were perhaps a little bit ahead of their time. The intention was really to put contracts out into the market that would be relevant 1 or 2 years after launch. And so I think we still feel like those are the right products to have. That's where the market's evolving to. But beyond that, we're looking at what are the next compliance markets that need the price discovery that a futures curve provides. And so going forward, I think there's really two areas that would make sense for us. One would be something much more removals focused. Obviously, the two contracts that we have today, the underlying supply is avoidance based. And the other is some of these regional compliance markets that are in the process of developing, whether that's in Singapore, as I discussed, Japan, or elsewhere, where there is a floor in demand. The challenge historically with the voluntary carbon market is trying to identify where that demand is going to sit. And we've seen something of a whack-a-mole type scenario play out over the last couple of years with various different methodologies being criticized and corporates jumping from one safe space to another. Obviously, compliance markets avoid all of those challenges. We really kind of will look to cater to that certainty of demand.
And over the past few years, while the voluntary markets were being stuck in that game of whack-a-mole, as you said, it did seem like we were seeing more and more regional compliance markets coming forward, or at least being in the planning stage. Is that still kind of a trend that you're seeing of more areas developing their own compliance markets or implementing carbon taxes that can utilize these types of offsets?
I think we're certainly seeing more and more jurisdictions actively developing carbon markets and carbon trading. We've seen that recently in Brazil, in South Africa, in Indonesia and Malaysia, as well as Singapore and Australia and Japan. So the number of jurisdictions that understand the benefits of carbon markets is continuing to grow. I think the challenge is building out that capacity and understanding. And that doesn't happen overnight. That's a multi-decade phase, as Mark identified in last week's episode. The EU ETS is now going on 20 years old. And it's been through ups and downs, and there's been a lot of learning along the way. And I think all these other regional compliance markets are going to go through the same learning curve. They're not necessarily going to get it right first time round, but they're going to continue to evolve and improve. And I think it's still my expectation that we will see a variety of global carbon prices develop over the coming decades.
You had brought up earlier that there's still a preference amongst many, I think the hyperscalers especially, for removal type projects as opposed to reduction or avoidance. Are there certain types of removal projects that are becoming more interesting as they develop? I know the knock-on removals has always been about scalability.
It really depends what you're looking for. I mean, as an exchange, obviously, we're focused on kind of catering to that pool of liquidity. And I would argue for the most part, most of the removals methodologies remain too niche today to really allow for deep liquidity to develop. That being said, there are segments that probably are now being developed to an extent that there is a depth in liquidity. Thinking about things like biochar and ARR for the time being, recognizing that DAC in the long term probably represents the deepest potential pool of liquidity and the most homogeneous pool of liquidity. There are still obviously technological challenges to overcome, particularly with DAC and biochar, that will allow it to kind of rescale and for the price to come down to a point that is commercially viable. I think if you look at most of the DAC offtake today, they're still north of $500 a ton. And that obviously leads to challenges around scaling the market. But what we're starting to see is the interplay between, let's say, DAC and some of the sustainable fuels. And certainly in Singapore, we're seeing a real push for the growth in sustainable aviation fuel and sustainable marine fuel, as well as things like bio-LNG and bunkering of some of these sustainable fuels in Singapore. So the market is growing. There are obviously an abundance of more niche methodologies out there, like enhanced rock weathering. And hopefully the likes of Microsoft will continue to deploy capital for those technologies to mature to a point that they really allow for scale. Because obviously at the end of the day, we want to hit that gigaton type market. And we're going to need a little bit of everything to achieve that.
And as I said, you're head of environmental markets at Abaxx, which is much wider than just carbon markets, starting off with the JRED Plus and Corsia Phase 1 carbon unit offset contracts. I wanted to get your thoughts, when you look at a market as kind of dynamic and as uncertain as the environmental markets, maybe just how are you thinking about developing new products for the market and for a market that has so much to react to and where people are struggling to see the path forward?
That's a great question. And I think if I think back to my expectations of how the market would have evolved 4 or 5 years ago versus where we are today, there's a bit of an inflection point. It's certainly clear that the energy transition is going to take a lot longer than I think most of us expected, and will be a lot more complicated than most of us expected. The concept that coal is on the way out is probably somewhat unrealistic, particularly in light of China's record high growth in power plants. I think what we're trying to do is work out what are the more viable approaches going forwards. Obviously, hydrogen is still kind of high up on the agenda for Europe, but I think it's going to take a lot longer for that to be a viable fuel that we can depend on, and that's going to require the physically deliverable benchmarks that we at Abaxx look to build out. That being said, there are areas of opportunity. And I think in this increasingly volatile world, there are more and more calls for better benchmarks, particularly physically deliverable benchmarks that allow for better price discovery. We're seeing that in some of the sustainable fuels like ammonia and methanol, but also in more niche subjects like weather derivatives, where the role of renewables is leading to increasing price volatility. Nowhere is that more apparent than Germany, where you've got pretty major swings in power pricing. Equally in Japan, where we've seen a number of the merchant traders set up Japanese power trading businesses. So I think there are real opportunities out there. It's about working with the market to identify them and build solutions that work for all.
Thanks again to Alasdair Were, head of environmental markets at Abaxx Exchange. We hope you enjoyed the episode. We'll be back next week with another episode of Carbon Frontiers 2025. We hope you'll join us.
This episode is presented by Base Carbon, a financier of projects involved primarily in the global voluntary carbon markets. Base Carbon endeavors to be the preferred carbon project partner in providing capital and management resources to carbon removal and abatement projects globally, and where appropriate, will utilize technologies within the evolving environmental industries to enhance efficiencies, commercial credibility, and trading transparency. For more information, visit basecarbon.com. Base Carbon, sensible carbon investing. That concludes this week's episode of Smarter Markets by Abaxx. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abaxx Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.